a presenter is, okay, who is this person and why do I care what they have to say? So first and foremost, my name is Greg Klingler. I'm the CEO of GEBA, Government Employee Benefits Association. We've been around since 1957, assisting federal employees with their benefits and their retirement planning needs. I currently hold a Chartered Federal Employee Benefit Consultant designation, as well as a CFP, and I am a fiduciary. And over the years, I've appeared on Federal News Radio, Government Matters, and a number of print articles that many federal employees have read. Where am I from? As I said, GEBA. We were founded back in 1957 by federal employees. Our board of directors are active and retired federal employees. But what may set us apart more than anything else is three words: expertise, experience, and motivation. We have financial advisors on staff who hold Chartered Federal Employee Benefit Consultant designations, which means we know federal benefits extremely well. And what may be more importantly to you today is we know all of the different offers that federal employees are receiving now as they talk about reductions in force and what they mean to your pension. Experience, our advisors have at least 10 years of experience. And lastly, motivation. Our board of directors is very clear. They wanted nothing to stand in between the best advice for federal employees and us, which is why our financial advisors are compensated based on salary and not commission. So with that being said, let's get started. All right, so for the next 9 slides or so, we're going to talk about exactly what a lot of federal employees are seeing. They're seeing all of these offers, and all of these offers are designed to dangle a carrot in front of people with the ultimate goal of a reduction in force. There's been a lot of talk about what that means. I've seen, going back to 2019 numbers, which would be a 20 to 25% decrease across the board, but I have seen other numbers quoted as well. So how did it start? Back in January, an offer was made for a deferred resignation. You had to make a decision by February 6th, and then between February 6th and September 30th, you could maintain your benefits and pay, and then at which point your retirement would become official. There were a lot of questions on whether that was legal, whether that would work, the fact that it was before the March 14th budgetary bill. At the end of the day, Judge O'Toole up in Massachusetts said it was okay, but many people did not take advantage. After that, the federal government started pushing additional options, including VERA, the Voluntary Early Retirement Authority, its very, very related cousin, the Discontinued Service Retirement. There was an offer that was either in conjunction with or by itself these other benefits, called the Voluntary Separation Incentive Program. And then below the line of voluntary leaving, there was involuntary leaving, elimination of agencies or job functions, elimination of positions, and then there was the back and forth with probationary employment layoffs, which are now back on the table on an agency by agency basis. So as we start thinking about retirement, there are 3 things that generally most federal employees need to consider above all else: your pension, your TSP, and your Social Security. So right now we're going to talk about the pension. Under traditional forms, in order to get full retirement, you must be at minimum retirement age, which for most of you is 57, with 30 years of service, or age 60 with 20 years of service, or age 62 with 5 years of service. If you retire early, you're subject to a 5% reduction in benefit for each year you are below the full retirement age. And your access to health insurance, which is heavily subsidized by the government as it stands right now, your access to health insurance may not be available depending on the circumstances. All right, so VERA. When people used to talk about the ideal situation as they came closer to retirement, VERA was that ideal situation. People also referred to it as an early out. If you have if you're at least age 50 with 20 years of service, or any age with 25 years of service, you can effectively retire with no reduction to your pension and maintain coverage with your federal health plan, as well as your FEGLI, your FedVIP, your dental, and your vision as well. One of the big issues that people are starting to run into at this point, and most people didn't realize this, is if you retire before your age 55, even if it's full with a full pension, you cannot take your TSP until age 59 and a half. The moment you cross the 55 threshold and then retire, then you can take your money immediately. If you're 54 years and 364 days and you retire, you cannot take your TSP until age 59 and a half. That's definitely something very important to understand. Moving on to the cousin of the VERA, discontinued service retirement. This has the same eligibility requirements, age 50 and 20 years of service, any age and 25 years of service, with one additional item. It requires the elimination of your job function. If you are eligible, it's going to work in many ways identically to VERA. You can retire before your minimum retirement age with no reduction in your pension. You're going to maintain access to all of your insurances, the health plan being the important one. And you're going to have to worry if you're pre-age 55, you cannot take money out of your TSP until age 59 and a half. I should put the caveat on this. Under traditional circumstances, you cannot take your money until age 59 and a half. There are ways to take equal and periodic payments that the IRS will allow you to access your TSP early, but it's through a very structured and defined calculation, and it requires you to take money out over an extended period of time each and every year. If you have questions about that, we can definitely help with that calculation. All right, the next one. Now, this has been used, depending on the agency, in conjunction with VERA or by itself. This is the Voluntary Separation Incentive Program. Legislatively, they can offer you up to $25,000 to separate from service. Again, can be used by itself or in conjunction with other carrots to convince people to voluntarily resign or retire. All right, so now let's talk about non-service, non-VERA separation of service. So now we don't have the ability to have an unreduced pension if we're retiring early. Now our pension theoretically is going to be reduced, or we have to wait to take our money. So the first item is postponed retirement. And the key here is you are at least of minimum retirement age. You don't have enough service credits to be able to retire fully with no reduction, but you are at least of minimum retirement age. You can take it immediately with a 5% reduction. And if you take it immediately, you can maintain your health insurance as well as your FEGLI. Or you can postpone your retirement until you become eligible. So now your age and your numbers of years of service have to match. So age 60 with 20 years of service, age 62 with 5 years of service. Once you become eligible, you can turn on your pension that is unreduced, and you can turn on your health insurance, and you can turn on your FEGLI. One important item to note is while you're waiting to turn on your pension, you will not have health insurance. But if this is a strategy that makes sense for you, there is a legal program called COBRA, which will allow you to bridge the gap at your own cost with no subsidization for up to 18 months. Because you're over minimum retirement age, which is above the age of 55, your TSP is accessible penalty-free immediately, and the COLA starts upon receipt of your pension. Slightly different scenario. FERS deferred retirement. The difference is these are people who are not eligible for full retirement and below minimum retirement age. These people will not have the ability to maintain their health insurance. They will defer their pension until they become eligible, so 60 and 20, 62 and 5, at which time they can start taking their pension, and at which time they can choose a survivor benefit. If while they're deferring, they happen to pass away, their survivor is not eligible to any benefit other than the lump sum that they put in. All right. Anybody who takes advantage of this below the age of 55 cannot access their TSP until age 59 and a half. And the COLA does not start until age 62. All right, that's just a quick summary of what we just discussed. So now all these offers are being pushed in front of you. Are you ready to decide? What does your thrift savings plan look like? And that has been changing very dramatically over the last 4 weeks or so. What's the effect of it on your pension based on what offer you are subject to? And Social Security, how is that going to affect your financial plan? And what other assets do you have at your disposal? So the first one, and this is a large one for federal employees, it's the thrift savings plan, which unfortunately is probably a little bit smaller today than it was 2 months ago. Most of you know the contributions limits. In 2024, it was 23,000. If you were over the age of 50, it was 7,500. If you were the ages of 60 to 63, they actually have a bonus catch-up that you're eligible for. There's a match. Most federal employees should be putting at least 5% in to maintain the maximum match. If you're not, it's free money. You probably take advantage. And then you have a number of investments. Now, this does not include the TSP mutual fund window, which can be a bit complex. And if you have an account above the amount of 40,000, you can put some of your money into it. These are just the standard funds that are available to the TSP, organized by level of risk. On the top, it's the I fund, which is international, which is subject to both exchange rate risk, political risk, and obviously typical equity risk. Below that, we have the S fund. It's a bit of a misnomer because it's mostly mid-cap, but there is some small cap exposure as well. The next one we have is the C fund, large domestic companies. This effectively mirrors the S&P 500. And then we have the L fund, which is a combination professionally determined by your age that includes the I, the S, the C, the F, and the G fund. Moving down, we have fixed income. 2 years ago, if you would have asked me what if the F fund was good, I would say probably should not invest in it. Interest rates are low, and if interest rates rise, the value of the F fund is going to go down. Today, we're in a much more stable interest rate environment, and our interest rates are much more in line with history. The F fund makes a lot more sense than it has in a while. And then we have the G fund, which is designed to mirror the returns of the 10-year Treasury. One item to note, there is some legislation that is working its way through the system that is talking about reducing the G fund. And conceptually, the idea behind it is, okay, well, if we're mirroring the 10-year Treasury, that involves you holding the money for 10 years. Why would we give the same rate to the G fund, which allows immediate ability to get in and out? So that's the concept and logic behind the idea that they may be reducing the G fund's return. And then below that, we have things that exist outside of the TSP, like money market funds, CDs, treasury bills. One item to note, while the I fund is considered the most aggressive, introducing the I fund or international exposure into a portfolio actually reduces the overall risk of a portfolio. It seems a little bit convoluted, but let me give you an example. The first quarter of this year, when the Magnificent Seven, like Tesla and Nvidia and Meta, did very poorly, international funds did very well. And because they don't move in lockstep, adding both of those items to a portfolio tends to make the portfolio, based on modern portfolio theory, tends to make it less risky. All right, there is some misinformation floating around on what you can do with your money in your TSP and how you can remove it in retirement. And the main reason for the misinformation is because the rules changed. In 2017, the TSP Modernization Act actually substantially improved how a federal employee can remove money from their TSP. It was implemented in 2018. So now the rules are, you can withdraw money. It has to be at least $1,000 in retirement once every 30 days. So theoretically 12 times per year. If the money is paid out to your bank account, either in installment payments or a single payment, and the money comes out of the traditional side of your TSP, it's going to be taxable. If you transition that traditional side of your TSP to an IRA, and there are reasons to do that, diversification, the ability to take your money early if you need to, if you retired before the age of 55, you can do so through a non-taxable transfer. You can also choose an annuity, but once you choose it, you can't take it back. You're effectively trading in a lump sum of money for a stream of income for the rest of your life. If you live for a long time, it's probably going to be worth it. If you pass away early, the money is going to get reabsorbed into the system. If you're currently working and plan to remain working, and you're over the age of 59 and a half, you can actually take up to 4 withdrawals per year. All right. So beyond the TSP, another source of earnings, income, and assets for federal employees are traditional and Roth IRAs. Now, the comments I'm going to make on this are going to be accurate for both the TSP and their traditional and Roth components, as well as IRAs. So traditional IRA, you put in money, you get a tax write-off on day one. Any money that you receive, you receive when you take it out in retirement, it's going to be taxable. The Roth side, you're going to pay taxes up front. When you take the money out, the money's going to come out tax-free, both the amount of money that you put in and the interest that you earned. Conceptually, if tax rates don't change, these are identical. There is no difference. But if tax rates change, that's when one can be better than the other. For instance, if your tax rate is higher right now than it's going to be in retirement, the traditional IRA is going to make more sense. Take the tax write-off today, pay taxes later. If your tax rate is lower today than it's going to be in retirement, then it makes sense to wait until retirement to pay taxes. Or excuse me, to pay taxes today and then wait until retirement not to pay taxes. Now, keep in mind, there is some talk among the administration right now about reducing income taxes. So that may have a influence on which is best for you. Reduction of income taxes today may mean paying taxes today a better choice. The Roth IRA does not have required minimum income distributions. The Roth component within the TSP does, so keep that in mind. So as you retire, at some point during retirement, pulling the Roth component out of your TSP and putting it into an IRA makes sense from a planning standpoint. All right, other investments. CDs, money markets, to a lesser extent, stable value accounts, and then for people with brokerage accounts and outside investments, mutual funds, stocks, bonds, annuities. Things to consider when it comes to investing. Risk tolerance matters. Risk tolerance is a combination of your investment time horizon, how long you have to invest, because the thing that smooths out risk more than anything else is time. The second item of risk tolerance is your personal risk tolerance. The last thing we want to do is put you in a portfolio that's too risky for your comfort. If the market corrects, and healthy markets do correct, we don't want you pulling your money out, because that's the worst thing that you can do. We want to make sure your portfolio is comfortable for you in the good times and the bad. Traditionally, riskier investments over the long term will yield higher returns. All right. And diversification matters. Even if you choose multiple different asset mixes that by themselves would be more risky, if they don't move in lockstep, putting them together can create an overall less risky portfolio. Your typical asset allocation is going to look like this. This is obviously overly simplistic, but you have your equities, your stocks, large, mid, small, international, emerging market, maybe some real estate. You have some bonds, corporate, government, foreign, which may be subject to interest rates. And then you have your really safe liquid money like cash. What I normally look at when it comes to a portfolio is not necessarily what's in a single account, but I look at all of your accounts together. Because at the end of the day, in your retirement, you're going to be using them in conjunction with one another. All right, so let's quickly talk about the market. The information on this is a little bit dated, but it definitely gets the point across. So I'm sure if anybody's watching the market, I've seen the market go up in a single day. When I say market, it's the S&P 500 in my opinion. I've seen it go up 10% in a single day. I've seen it drop 8% in a single day. And it seems like comments from President Trump can actually dictate about a 3% swing in the market, good or bad, is what we're seeing. So there is a lot of short-term uncertainty, but long-term, a good portfolio a month ago is still a good portfolio today. I'd just like to introduce some words of wisdom by some guy who's known for being a pretty good investor, Warren Buffett. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. I think that one of the biggest keys is keeping emotions from corroding that framework. In my experience, and as it turns out in Warren Buffett's experience as well, emotions are what can cause very intelligent people to make very poor financial decisions. And if there's anything we have a lot for in today's market, it's emotions. All right, so let's look at what happened in 2024. Domestic did very, very well. International did not do so well. And frankly, that's been a trend over the last about 10 years. Warren Buffett had another quote, trees do not grow to the moon. Asset classes are not going to be the best asset class forever. In fact, studies will show us that an asset class that exceeded everything else in one year tends to correct and go and be a lower asset class in the following year. Most asset managers were actually pushing a lot of money at the beginning of the year into international. And in retrospect, internationally, in the first quarter of 2025 did much better than domestic. Over a 10-year period, again, large domestic, the Magnificent Seven has done extremely well. But there will be a time, just looking at valuations both at the domestic level and the international level, where that's not always going to be the case. Investing in international in your portfolio, even though the last 10 years has not been great, still makes sense, because there will be a time, and looking at valuations, that time is going to come sooner rather than later, that international will outperform domestic. 3 years ago, bonds were not strong. Now that interest rates have stayed, for the most part, stabilized and are much higher in relative to history about what history expects, bonds have become a much better asset class to invest in over the last year or so. As you can see, the Magnificent Seven, which is a very large percentage of the S&P 500, has done extremely well, and that has carried the S&P 500 in its wake. All right, I made a comment about how we care about your investment tolerance, your personal comfort level when it comes to losses, because this is the last thing that we want to have happen. The market crashes, it hits a point, and you get out. In 2008 and 2009, we saw a lot of people do that. And if that person had just got out of the market and stayed out of the market for 1 year and got back in, they would have an account value that was almost $500,000 less than the person who just rode out the market, who was comfortable with their portfolio. So having a portfolio that matches your time horizon and matches your comfort zone is incredibly important. We mentioned time horizon. If there's anything that smooths out risk more than anything else, it's time. After 5 years, no matter what crisis we've seen since 1989, the market's up in a 60-40 split because time manages out any market. In fact, in the history of the modern market, the market has never lost money over a 10-year period. So again, very simplistic conversation, but if we have money that's earmarked for more than 10 years out, and most of your retirement is probably going to be 20 or 30 years in nature, that money can be pretty darn risky. What we want to have protected is the money you're going to be spending in years 1 through or years 0 through 5 and years 5 through 10. And that's where those bonds and those liquidity and the money markets and stuff come into play. I'll say it again, time smooths out risk. As you can see, now this says a 15-year annualized return, but also for 10 years annualized return, there has never been a period of the market that has lost money. And then frankly, in over a 5-year period, the odds of you losing money are very, very low. I mentioned Warren Buffett's quote, trees do not grow to the moon. This is an example of what I mean here. In 2007, the top earning investment was the emerging market. In 2008, it was the worst. In 2009, it was the best. Traditionally speaking, historically speaking, if something does very well for a year or two, the next year it probably will not do nearly as well relative to the other asset classes available. That's why diversification is so important. As you can see, the most consistent return relative to other asset classes is the balanced fund because it's relatively diversified. All right, I thought this was an interesting slide. So returns by presidential party. The Democrats have actually beat the Republicans. It gets a little bit closer when we start talking about one-year lagged returns as policies start taking effect. It's much closer to even. All right, so as we look at our investments, we want to recognize our bias. People tend to experience loss at a much higher magnitude than gains. And that causes people to make emotional decisions. So understanding your biases, understanding your feelings, understand how you react to risk, and separating yourself from those and look pragmatically, that really is the goal when it comes to investing. And the other item just to note is when change happens, in most cases, there are opportunities that are present. The key is to, again, look beyond the fear or the emotions and look for the opportunities. All right, so let's quickly talk about the annuities. I'm going to skip very, very quickly over the CSRS employees just because we have about 4% of CSRS employees who are currently employed right now in the federal government. That number is going down very rapidly. And every single CSRS member, if they choose to retire, could retire today without any penalty to their pension. One thing I'd like to note, if there are any CSRS employees on this presentation, if you don't know what the voluntary contribution plan is, give us a call. It effectively allows you to supercharge a Roth IRA if you have money in the bank up to an amount that is equal to 10% of your lifetime earnings. Putting the money in, any gains will never be subject to taxation. That's a little wrinkle in one of the rules, but it's absolutely legal and absolutely true, and we've had people do it. All right, FERS employees. All right, so FERS employees rely on what we call the three-legged stool. We have Social Security, we have the TSP and the associated match, and then you have the FERS calculation. The FERS calculation is pretty straightforward. If you have 20 years of service and age 62, the factor that you multiply by your number of years of service is 1.1%. For those of you who have not reached age 62 or 20 years of service, that factor is multiplied by 1%. You have 3 survivor benefits at your disposal. 50%, which is the highest, 25%, and 0. One item to note, if you choose 0 and you have a spouse who needs health insurance that's offered through the federal government, they will not be eligible for it if you choose 0. The spouse has to receive some money in the form of a pension in order to be eligible for federal health benefits, provided they were not a federal employee. All right, so a quick example of the FERS calculation. Again, age 62 with 20 years of service gets you 1.1%. You have to have both 62 and 20 years. We have Sean Jones, 30 years of service, so at least 20 years. Retiring at age 62, at least age 60. Sean is eligible for 1.1% times the number of years of service, 30, equals 33%. If the average of his 3 highest paid years is 100,000, he would be eligible for an initial pension of $33,000 per year. One item to note, in legislation right now floating around Congress is the idea that they may be expanding the calculation to from average of your 3 highest paid years to the average of your 5 highest paid years. I don't know if that's going to pass or not, but just want to let you know that that is floating around there in legislation right now. All right, if you retire before the age of 62 with a full pension, and I do see questions coming in, I'll be answering the questions as best I can after the presentation, just to let everybody know. For those of you who retire with a full pension before the age of 62, you have access to what's called a special retirement supplement, or a FERS supplement, or a Social Security supplement. Those terms are kind of used all as the same thing. And what it is it's to bridge the gap between when you can retire and when you can start taking your Social Security at age 62. And in most cases, the way it's calculated is its total number of years of service divided by 40 times your Social Security age 62 benefit. To give you an example, we have Jane Smith, FERS employee, 30 years of creditable service. She's reached her MRA, which is age 57, so that means she's eligible for a full pension, which means she's also eligible for the FERS supplement. At Social Security, at 62, her Social Security benefit is $1,200 per month. So it's 30 years of service divided by 40, which is 75%, times the age 62 Social Security benefit, $1,200, equals $900 in the FERS supplement. She will get paid that every month with no COLA until age 62. At age 62, it will stop whether she takes Social Security or not. All right, Social Security, the last leg of your 3-legged stool. Almost every FERS employee will be eligible. It effectively takes 10 years or 40 credits, but 10 years to become eligible for Social Security. How do they calculate it? Well, they take your actual earnings and they index it for inflation. And they take the top 35 years of earnings. If you don't have 35 years of earnings, they will be factoring in zeros for every year that you don't have a year of earnings. They average it all out, and they create an average indexed monthly earnings amount. And that's what they use to calculate your Social Security amount. Depending on when you were born, if you take it early, and you can take it in generally as early as 62, if you're a widow or a widower, you can theoretically take it as early as age 60. You're going to see a 25 to 30% reduction, depending on your birth date. Your full retirement age is going to be somewhere between age 66 and age 67. Every year that you wait past that, you're going to get an 8% increase in your Social Security full retirement amount, which means at age 70, depending on your birthday, you should expect to see between 124% and 132% of your full Social Security amount. So how can you draw Social Security? Well, you can draw it off of your earnings. If you were or your spouse was a homemaker, you can draw it off your spouse's earnings, but you can only get 50% of that. If you are a widow or a widower, you can draw the greater of the deceased spouse or your amount, but you can only take one. So other things to consider as we kind of work through this process. If you are married, what are your spouse's needs? Is the spouse substantially healthier or younger than you? If that's the case, we need to understand how your Social Security and your pension is going to work post your death. Social Security, most federal employees are 85% of their Social Security is going to be taxable. Any decision that you make is going to be magnified by COLAs. How's your health? How's your spouse's health? In many cases, Social Security is just a break-even calculation, especially for single people. If you're going to live past the age of about 83, it makes sense to wait to take Social Security. If your health dictates that you won't, then taking Social Security early may make more sense. Are you planning on still working? Most people cannot take Social Security and keep the money if they are earning a paycheck as well until after they reach their full retirement age under Social Security. Do you come from a long-term family? I think, again, that leads to longevity. And do you need income? From a financial planning standpoint, we can talk about the most efficient uses of Social Security and your pensions, but if you need the income, well, that's going to dictate when you take things. All right, next, managing risk. So we've talked about investments, we've talked about income, we've talked about Social Security. The one thing, part of the financial plan that we have not talked about is risk associated with your retirement. Typical risks associated with your retirement. Well, death, especially for the surviving spouse that you leave behind. Disability, health, dental, long-term care, and then obviously we have the property and casualty like home, auto, and umbrella insurance. This is general. It's not going to be correct for everybody. For those people who need to protect their loved ones because income is associated with their life insurance is generally required. Now, life insurance can be purchased effectively by purchasing a survivor benefit on your pension, if that's enough to cover your spouse. Some people actually choose to the maximum pension and then buy life insurance instead, banking on the fact that they're healthy. Health insurance, very, very important. The federal health plan is extremely good. It has a subsidization rate of about 74%, which is better than you can get pretty much anywhere. So maintaining health insurance is going to be very important. The civilian federal plan is excellent. The only time you would not choose that, to be perfectly frank, is if you were part of military service and had TRICARE. Just for your reference, TRICARE requires you to sign up for Medicare Part B. FEHB, or the federal civilian plan, does not. So factor that into your calculations as well. Dental insurance, it's good to have. Typically, it's not going to make anybody go bankrupt, the cost of dental care. Long-term care insurance, this is a big one. For those of you who are age 65 or will be 65, at that time, there's a 50 to 70% chance that you'll need long-term care in your lifetime. That's what the studies show us. The studies will also show us that if you get put into a long-term care facility, men will be in there for 2.2 years, women will be in there for 3.7 years. The cost of care, where you retire, matters when it comes to long-term care. It can vary very, very widely. In Texas, the median cost is about $83,000. In Connecticut, ironically, that's the most expensive one. The cost is about $190,000 for a nursing home. Washington, D.C. area, $168,000. Where you retire absolutely matters, both from a state income tax perspective, but as well as we try to quantify the risk associated with your retirement. Does everybody need long-term care insurance? The answer is no. If your assets and your pension are large enough, you can self-insure. For those federal employees who can't, they can typically self-insure a portion, and then they would need to outsource the rest in some capacity. In many cases, that capacity is using insurance. All right, FEGLI. As you retire or resign, there are questions that are asked. One of those questions is, okay, what do you want to do with FEGLI? I can tell you that option B will get very expensive because it keeps going up as you get older. I have never seen anybody maintain option B past the age of 74, and I've worked with a lot of federal employees. If you are in struggling health and you need to protect your loved ones in the short term and you have FEGLI and you're otherwise uninsurable, absolutely you want to keep it and pay whatever cost it is. If you're in good health, there are traditionally better ways if you still need insurance post-retirement. Now, there are two types of FEGLI that I recommend you keeping post-retirement, and that's because they reduce to 25% of what they once were. Then they stay at 25% and it's free. And that is basic and option A. Now, you need to have coverage for at least 5 years before you retire to be able to continue it into retirement. But if you're going into retirement, I highly recommend, even if you don't need insurance, take the basic, take the option A, take the full reduction, enjoy some free coverage. Health insurance. With the exception of TRICARE, which does require you to sign up for Medicare Part B, which can be pretty expensive. Most of our clients pay each between $150 and $250 per month for Medicare Part B. In some cases, that still makes sense to maintain the TRICARE with Medicare Part B. The federal the federal health plan does not require Medicare Part B, and it is subsidized about 74%. It does vary from plan to plan, but it's about 74%. As a general rule, if you have the federal health plan, I don't recommend Part D. Typically, your health plan has much better coverage than what Medicare Part D offers anyway. Part C is generally not needed. And frankly, only most conservative people tend to choose Part B. All right, I've already kind of beaten this horse to death when it comes to long-term care insurance. Most people sign up for it in between 50 and 60. The highest rate for being accepted is in the early 50s. The reason why, frankly, is because it's still relatively reasonably priced. And if for many people who have children, their children are out of the house and now they're focusing on themselves. So socially speaking, they start looking at it. That's one of the reasons why. And they buy it at that time because it still represents a relatively inexpensive cost. Although full disclosure, because long-term care protects something that's likely expensive and has a high duration, long-term care insurance is pretty expensive. In the past, you had two options. You had private insurance with a lot of different alternatives, some of which were life insurance, long-term care combinations, and you had the federal long-term care plan. The federal long-term care plan has been frozen for quite some time, and we don't really know when it's going to unfreeze. Theoretically, it could unfreeze as early as December of 2025, but it was postponed already a year, so who knows? For those of you who have the federal plan and you've had it for at least 3 years, it's not going away, and it's probably going to represent the best thing you could possibly get nowadays. So you definitely want to maintain it. All right, and I'm happy to discuss that more with people on a personal basis. All right, so planning for your future. Retirement is your priority, and retirement may be in this environment thrust upon you, whether voluntarily or involuntarily. Some important just concepts. You can't borrow for retirement. People aren't going to lend you money because you're not going to be making money to pay them back. If you have to decide between a child's education and retirement, well, a child can borrow money. Ideally, we want to be able to do both, though, right? All right. So as you make a decision, again, separate emotions and bring experts into the equation. If you have a financial advisor who is an expert on what's happening in the federal marketplace today, who understands federal benefits and you trust, that's the person you want to talk to. If you don't have one of those, you can definitely feel free to reach out to us. We were put on this earth back in 1957 to help federal employees in their time of need. And this is a time where we feel we can do a lot of good. All right. So I got it about right. We have about 12 minutes for questions. And I did see some some items come through, so let me take a look. All right, so will this presentation be shared? The answer is yes. Slides will be available? Yes. We have recorded it, so yes, we will be sharing a recording. Let's see, what about the stock market in 1929? So unfortunately, I don't remember exactly when this was put in. Obviously, the Great Depression was a major source of issues caused by a lot of things, actually environmental as well as financial. Liquidity was one of the first issues that occurred. We don't have a liquidity issue here. We don't expect one. So it's not going to react like it did in 1929. And frankly, the market's not going to react like it did between 2007 and 2009 because there is so much equity in people's homes. So again, it's going to react differently than those items. Time will tell exactly how it reacts, though. Survivor benefit options. Is it for a spouse only? In most cases, the answer is yes, but in some cases, it can be pushed on to minor children. All right. Any knowledge whether the proposed high five will grandfather employees in or will be immediately applicable to all federal employees? So this was my comment about how their legislation is bouncing around, talking about extending the calculation of the pension. It currently is the average of your 3 highest paid years. They're talking about making it the average of your highest 5 paid years. Currently, what was originally pushed out did not mention grandfathering in. Time will tell if it passes and in what form it does pass. Traditionally, our legislator likes grandfathering in people. Those of you who are retired would be the obvious choice, and then there might be some grandfathering in before that. Unfortunately, I don't really have any information on that. All right. Annuity supplement, MRA plus how many years of service? So in order to get the FERS or Social Security supplement, you need to be able to retire fully. So in order to retire fully, it can be MRA in 30 years of service, or you can retire fully at age 60 and 20 years of service. Both items will allow you to retire before age 62. And if you retire fully before age 62, you are eligible for that FERS or that Social Security supplement. All right. Am I understanding this correctly? The FERS supplement stops automatically at age 62 when we are eligible to start collecting Social Security. But there is a % penalty to Social Security if we start collecting at age 60, before age 67. So the answer is yes. Now, the FERS supplement, the calculation is based on the reduced Social Security age 62 benefit. But at age 62, it will stop. And if your full retirement Social Security age is age 67, which most of you are, you're going to see a 30% reduction to your unreduced Social Security amount when you turn it on at age 62. Again, if you don't turn it on at age 62 and you wait till your full Social Security amount, that's your prerogative, but the FERS supplement will stop. All right. I'm 57 and a widow. He died 6 years ago. When you said I could take my late spouse's Social Security or my own, would I still be penalized for taking it early? I believe 60 is the earliest I can take it, and that his is lower than mine and would be later. How would that work? So there were a lot of loopholes that existed before 2016. They closed most of them. They did not close a loophole for people in your situation who have a spouse who was deceased. I don't want to get into too much detail because it's kind of specific, But basically what you can do is you can take his at age 60, create income for yourself, and you can switch to yours at a later date, probably somewhere longer down the line when your Social Security has increased to a larger amount. So at age 67 or even 70. That's a play that people who have a spouse who died, it's a loophole that they can still take. So depending on how the numbers work, take his at 60, take yours at 70 or 67 or something. Or theoretically, you could take yours at 62 and his at age 67, whichever works best. But I know I'm moving through that a little bit quickly, and I know that's a little bit complicated, but please reach out. We can go over it together. Can you purchase long-term care as a retiree? Absolutely, you can. So as I mentioned before, the federal long-term care program is closed for everybody, and I don't know when it's going to be open. But the private sector, you can absolutely purchase long-term care, provided you can make it through underwriting. All right. Did you say feds do not need Part B in Medicare once they retire? So in order to maintain your civilian federal employee health benefits, you do not need to take Medicare Part B. You know, every person's financial situation is the same, but from my perspective, the cost of Medicare Part B in many cases for federal employees does not warrant the benefit because the FEHB plan is very good in itself. And again, there's no requirement if you have FEHB to purchase Medicare Part B. Now, military people who have TRICARE, they are required to purchase Medicare Part B in order to continue their TRICARE. All right. Thank you for a thoughtful wealth of information. Oh, yeah. One of the CSRS dinosaurs. Okay. And I do apologize for not going into your information more clearly. But please reach out to me. I'm happy to do the calculations. The truth is, you know, no matter what offer is on the table for I believe it's FDA, you know, you can take a full pension. So that's great. Now, if you don't know what the voluntary contribution plan is, it's a great way to take money that you have in your bank and make sure you never have to pay taxes again. So that's something that if you haven't explored it already, you should. And again, please feel free to reach out to me. We can go over those specifics. All right, I do see a hand up, but I just want to make sure I get through some questions. We got a couple more minutes. Let's see. All right. With respect to FEGLI, how is the 5-year requirement met? Does it have to be a consecutive period right before retirement? The answer is yes. Consecutive period before retirement. Can a separated employee who contributed for 20 plus years and return to service use so the answer is, as it stands right now, no. It has to be consecutive. 5 consecutive years before you retire to maintain your FEGLI. I apologize for paraphrasing. All right, what is your opinion on the FERS bridge supplement? Do you think Congress will eliminate it? So it's interesting. Let's see, in 2015, when Paul Ryan was in charge of the House Ways and Means Committee, that was something that was being highly addressed. I am not seeing it nearly being as much of a focal point as it was back then. That doesn't mean it's not going to happen. But the two things that were really addressed back then were the COLA, which is big, and the bridge. Today, I'm not seeing that. I'm seeing high 5 versus high 3. I'm seeing the potentially reducing the yield on the G fund. Those things seem to be talked about a lot more, but time will tell. If you leave the federal government after 12 years of service in your 40s, are you eligible for FERS once you reach retirement age? Yes, you would be subject to what the presentation called deferred retirement, but you would absolutely be eligible when you hit age 62. But yes, the recording will be available. Again, my name is Greg Klingler. I'm the CEO of GEBA. I'm a certified financial planner, a fiduciary, and I hold a chartered federal employee benefit consultant designation. Can you suspend Medicare Part B and or Part A if I live abroad? That's a good question. So Medicare Part A, there's no reason to suspend it because it doesn't cost you anything. Medicare Part B, I'd still want to go back to the reason why you purchased it in the first place. In many cases, for federal employees, especially federal employees with pretty strong retirement plans, Medicare Part B is not generally needed. If you have questions on that, please reach out. We can help. All right. If one does part-time instead of full-time, then can they still have pension and retirement benefits later? Yes. We have clients that work part-time schedules. In most cases, where our group's from, it's 30 hours, and they effectively just receive 75% of a year for every year that they work. So their federal pension calculation, if they work for 30 years or 40 years, it would only be 30 years of service. But yes, absolutely, part-time does allow federal employees to maintain benefits and from a calculation standpoint. Can appointments be made after 4:30? We generally work between 8 and 4:30, but with that being said, there are times where we can push out, but those times are fewer and farther between. So yeah, appointments can be made after 4:30. They're just a little bit harder to come by. All right, let's see. I believe there was a hand raised. All right, looks like it went down. Okay, I think at this point we've reached all of the questions. Yep, we got a Q&A. I apologize. What option or paperwork do I need to select to ensure my spouse can continue my FEHB if I die before my spouse? That's going to be in your retirement paperwork. Unfortunately, I don't remember the number offhand, but in your retirement paperwork, there is absolutely a question where you need to that you can answer that. And then the pros and cons of converting a traditional to a Roth IRA. That is going to depend on how much money you're paying in taxes, your tax bracket. If you have money set aside, we generally don't want to pay the taxes out of the traditional IRA. We want to be able to pay the taxes out of your bank account. It's much more efficient that way. So there's lots of questions. And the other question would be, what do you want to use the money for? Is the money you want to use, is it for inheriting, leaving money to your heirs? Is it for post-age 73 situations? Because that would be another reason why a Roth would make sense. So a bit of a loaded question. But again, as a general rule, if your tax bracket does not change, traditional and Roth, there's no difference. The only difference lies in whether your tax bracket is going to change. All right. What is the window of time to make an appointment if you're interested? There's no window of time. We're here, and we'll be here, and we stand here ready to help our civilian federal employees get through this very difficult time. Annuity supplement, MRA plus how many years? In order to get the annuity supplement, you need to retire fully. It's MRA plus 30 years. Again, my name is Greg Klingler. And typically, what is a time commitment for an appointment? All right, so that's actually a great question. Because we're a nonprofit, we do things a little bit differently. We don't like just giving people recommendations without knowing you. So what we like to do is we like to get to know you, and traditionally, we actually like to do a free and no obligation financial plan for you. In order to do that, that generally takes 2.5 meetings. So about 2.5 hours. But we have found is that allows us to give you the best information possible. And it does come with a free financial plan that we'll send to you. Again, no obligation. Again, we're a nonprofit organization. It allows us to work a little bit differently than most financial institutions. All right, if tax will be lower at an older age, do you suggest a traditional IRA or a Roth? So if you're going to be lower at an older age, then you want to pay taxes at that older age, which means you want to defer taxes at a younger age. That would make traditional the traditional IRA the appropriate choice, or the traditional portion of your TSP. Same thing. All right. We're a little bit over. I apologize for that. Thank you, everybody, for joining. Hopefully, it was good information for you. I know this is a very trying time. If you didn't get something or you need some clarification, please reach out to us. It's no obligation. We're a nonprofit. We were put here on this earth to help people like you. Um, so yeah, use us as you see fit. Thank you and good luck to everybody.